All right, hello, everybody. This is John Rhoda at Riverbend Investment Management. Welcome to my Big Picture Weekly Market Update. This is for the week of October 21st, 2022. So to start off today, let's just take a look at where the strength in the market has been lately. As you can see, it's still energy. Energy has really been the strong performer this year. It's been bouncing around a lot lately, but it's still, in terms of technical signals, it's still fairly strong. You can see it's above its 50-day moving average, above its 200-day moving average. We've been seeing some short-term improvement in some of the other sectors within the market. This is more your short-term momentum turning positive, which is a first step in any type of market recovery. Ideally, we'd like to see that expand out into the longer term areas, such as a weekly signal, for example, before really getting excited about what's going on in the market. But I'll talk a little bit about where some of the opportunities are in just a moment. Looking at the broad indices in general, you can see the US dollar here. This has really been the strongest area as well. It's been having a bit of a negative impact on the market so far this year. And you can see here we're getting the negative momentum signals within the dollar, and that's helping benefit some of the broader indices here with some of the shorter term momentum changeovers. So again, ideally, we'd love to start to see areas of the market starting to trade above the 50-day moving average. We'd really like to start to see some of these areas improve on a weekly basis. Once we really start to see that, I think we're off to the races and we'll start to see a stronger recovery in the market. But till then, unfortunately, a lot of these areas in the market, the downtrends are still negative, and we're really just keeping a close eye on what's going on the shorter term to see if we can get some indication that there is some turnover to some positive changes that might last a little bit longer than just a few weeks. Taking a look at the S&P 500 versus the U.S. dollar, again, this has been the story of the year. As the U.S. dollar has been getting stronger and stronger over the year, it's been having more of a negative impact on stocks, especially on the technology sector. And you can really see that the U.S. dollar has been problematic for stocks this year. It's really starting to have an impact on some of the overseas countries as well, especially more of the developing nations. We've seen some impact, especially, for example, in Britain, with the strong dollar having an impact on some of their currency policies over there. So the dollar itself is reaching a point where I think the Fed may need to start to step in at some point and implement some type of policies to help weaken the dollar a little bit. If that happens, I think we'll see a stronger recovery within the market. Taking a look at the S&P 500 itself, I have a lot of lines drawn here. I'll walk you through everything because I think there's some important points to be made. First off, down here, this is our MACD indicator. It represents momentum. As you can see, we've had a bit of a kind of a whipsaw in momentum, and we're starting to trade back upwards in our momentum indicators. That's a good first step in terms of recovery in the market. These percentages here, these are your Fibonacci numbers. They are basically the retracement from the bottom of the COVID low to the recent top, and these Fibonacci numbers have an interesting impact on the markets, especially with short-term traders. They like to use these points as support and resistance. You can see here the market pulled right back to the 50% retracement and started recovering. We have our shorter-term downtrend here. We have our cloud support model, which tends to act as support and resistance. And we have this 38% retracement level as well. So this is all kind of coming together as a bit of an inflection point for the market. If we can trade above this downward channel and break above this 38% retracement level, I think we'll have some real positive momentum come into the market, and we'll start to see that reflected in some of the longer term indicators. So we're keeping a close eye on this level because I think this is going to be a very important level of resistance for the market. If we can really have some of the seasonal and historical tendencies come back into the market, we could potentially see this level break through and start to see a higher level within the market, ultimately testing this longer term downtrend within the market. Looking at some of the internals of the market, this is the percentage of stocks above the 50-day moving average within the S&P 500. You can see it's a very low number right now, and this is showing that any type of strength in the market here is not really having an improvement within those longer term indicators. This is the percentage of stocks above 200-day moving average, and you can see there's just really not a lot of stocks that are in that upward trend right now. So we would like to see further recovery in this, especially 50-day moving average, and start to see more and more stocks start to trade above that 50-day moving average. And that would be, again, another very positive sign. But right now, we're really seeing just low levels of market participation right now. And this is reflected in charts like this. So again, we want to keep a close eye on this because historically we are very oversold within the market, and we may see some type of bounce, at least short term, like we saw earlier this year. But again, longer term, we want to again see this trend start to reverse. Looking at our RRG charts, if you remember, these tend to rotate in a clockwise fashion. So we really like to look at areas that are improving in strength. Right now, that's energy. You can see the rest of the market is really starting to just turn negative lately, and these are weekly charts. They're a little bit longer term in nature, and they tend to pick up the longer term trends. But you can see here, really starting to get a bit oversold in all these areas. And when you start to see all these areas start to decline into this weaker area of the market, you start to have the start of a bottoming process. So that's what I'm looking for right now. But you can see here, really the only area that's having any strong outperformance is energy at this point. Now look at bonds. Now bonds have had obviously a tremendous impact on what's going on this year. Interest rates have really moved much, much higher this year as the Fed looks to really try to curb some of the inflationary data that's been coming out. And we've seen them just raise interest rates on the short term over and over and over this year. And that's having an impact on the broad bond market as well. This is the AGG ETF that represents the broad bond market itself. If you remember, interest rates and prices trade inversely. So as interest rates rise, we're going to see the same movement on the downside in terms of prices. And we can see here, that's exactly what we've seen, about 22% decline from the peak in our broad bond ETF here. These are your liquid, these are your investment grade corporate bonds, nearly a 29% decline from the peak. Look at your 30-year, your long-term bonds. These are 20-year plus bonds, your longer-term bonds, down 43%. So really some massive destruction in the bond market this year as interest rates seem to just kind of skyrocket this year. So this is going to have some type of impact at some point within the broader markets, as we might see some type of liquidity events going on in the bond markets, which might cause the Fed to have to start to reverse some of its policy and some of the tightening policies to help add some liquidity back into the bond market. But for right now, it's tough because a lot of people don't want to buy these longer term bonds because they just keep getting hammered. So if you're the U.S. Treasury issuing debt, who's going to be buying your bonds if your bonds just continue to decline in value? So something to keep an eye on right now, because this might have an impact down the road on what the Fed's policy might be later on this year or possibly next year. So are there any opportunities with the market, or is this all doom and gloom? Well, there are some opportunities. Like we talked about energy having some positive impact here. What we really like to see is setups like this. This is oil equipment and services, for example. We want to see setups where we have a sector moving into this leading category. So this is all these sectors versus cash, and we always want to own areas that are improving versus cash. We never want to own areas down here that have a negative momentum versus cash. We always want to have a positive momentum versus cash. And these are the areas where we start to see some opportunities. So for example, here, remember, these tend to trade in that clockwise fashion. So we would expect something like this to start trading into this leading category, showing the strength versus the broad cash markets, for example. And this is what we look for in terms of setups. We look here, these green shaded areas are really it's a bit of an internal algorithm I use to scan to represent the direction and the velocity that areas are moving into in terms of improvement versus cash. So that's what this green highlighted area is. Just this red, blue change over here. This is just a 2 standard deviation stop that we like to use. But you can see here, we're starting to see these setups where we have this sideways trading pattern in various areas in the market, and then we're having a breakout. And the breakouts are important because the market really, again, likes to take bets when we have patterns like this on one side or the other. And when there is a breakout, all the people that were, for example, short this side of the market have to go back and buy in to offset those positions. So that kind of adds to the fuel of these breakouts. And that's what we're seeing in areas like, for example, this oil and services area. The reason I bring that up is because let's look at the iShares ETF. This is the Russell 2000. We see a similar pattern, that sideways trading pattern. We have this longer downtrend here, and we're starting to see possibly a setup here where we might start to see a breakout, and that would be a really good sign for overall improvement in the market. So keeping an eye on these sideways trading patterns that are starting to emerge across the market, because again, if we can start to see these breakouts, this is going to be our first really good indication that the market wants to start to move higher, and that that traders are starting to take bets that the markets are going to go higher and have to offset these short positions as they buy back into the market. So again, something to keep an eye on. We're starting to see improvement in momentum as well, which could potentially lead and extend this rally here. But you can see we're again at these inflection points here within the market. And if we start to look at some of the historical and seasonal trends, we might be able to push a little bit higher and break out of some of these sideways patterns. So what am I talking about in seasonality? Well, historically, October, especially November, December, and January are very strong periods in the market. This is the S&P going back to 1950. So just looking at the monthly averages, where the strength has been within the market. And you have these seasonal trends, which typically favor the end of the year and the start of the year, that have been beneficial for investors. If you combine that with the historical trends, we have our 4-year presidential cycle. And what's more important here is a trend versus the actual direction. Versus the actual level, And you can see here the pre-election and the presidential election years tend to be the strongest in terms of performance and tend to be most favorable for equity investors. The midterm cycle, which we are right now, this is where you have the weakest area of the market. And this is exactly what we're seeing right now, just a very weak market. But we're starting to get to the point where if the historical and seasonal trends start to come into factor, this is where we're going to start to see these points and some of these inflection points I talked about starting to be tested. And like I said, if the market starts to look at historical trends, we might start to see a bit of recovery within the market. And again, the reason some of these trends work so well on a historic basis is that typically come this midterm cycle, there start to be some type of problem within the economy or some type of problem within the policy. And this is where you start to talk about solutions, and the country gets to vote on the best solution. So as you start to talk about solutions, the market starts to think about looking forward, looking down the road 6 months to a year, what might happen down the road, and they start to get excited, and then you start to see these type of markets start to recover. So that's really what I'm keeping an eye on, is again these setups that we're having here on these sideways trends in the market, and just watching to see if we start to have some of these historical and seasonality, if the traders start to favor these type of patterns and start to put some trades in place to take advantage of what may happen in terms of election cycles and seasonality. So those are the main things I'm keeping an eye on right now for the market. Like I said, if you have any questions at all, please feel free to reach out to me. The best way is by email at john.rota@riverbendinvestments.com. If you're on Twitter, check me out there at John Rota, where I post more daily and detailed charts. And again, I have the research blog at www.johnrota.com, where I post a little bit more in-depth charts and things of that nature. So hope everyone's doing well. And again, please feel free to reach out if you have any questions. Thanks so much. Bye for now.